Thanks, James. Good evening, everybody. My name's Dan Perkins. I'm the MD of Great Point Investments, and I'm here to sort of bring things to a close over the next 5 to 6 minutes. Hopefully, what I'm going to be able to do here is cover off a little bit about who we are as a business, a little bit about why the UK creative industries is a great place to invest your clients' capital. So we're a little bit of a different fund to the others that are presented this evening, and that's largely down to our creative industries focus, which is down to the people that are behind the business. And then towards the end, we'll bring it all together with what the fund is that we have available on the Kuba platform. So, who are we? Been around for 7 years now. As a management team, as a senior management team, we have over, and this is important, we have over 60 years of media sector experience, whether that be operating television channels, whether that be running production businesses, all aspects of the operation, commercial and investment management decisions made within those businesses. And I think that's key when it comes to investing into a particular chosen sector. Alongside that, we've raised over £250 million worth of tax-efficient investment through the EIS, SEIS and business relief strategies. And over the last 7 years, we've invested north of £400 million worth of capital across those UK creative industries. During that time, what have we actually done? What's our USP? Why do we believe that we're the managers to be investing with when it comes to the UK creative industries? Over that time period, we've forged some very, very strong relationships during our tenure at Great Point and as individuals throughout our individual careers. We have great relationships with the BFI, industry bodies like Creative England, and we have hugely strong relationships with most of the major broadcasters in the UK and in the US, Europe as well, and the streamers that are now becoming ever more popular in terms of the way that we consume content in the UK and globally. From a venture capital perspective and from a growth perspective, clearly that's what this evening is all about. We have examples within some of our SEIS companies that we've invested in over the last 5-6 years of some fantastic exits. The bearded chap in the top right-hand corner isn't me. That is a chap called Nathaniel Rateliff and the Night Sweats, who is far more talented than me. He was an American actor that we backed through one of our SEIS companies, 150k in. We exited 6.5 years later, September last year, at a gross multiple of 14.5 times. Obviously, alongside that, within that portfolio, there are a couple of SEIS companies that have also failed, but that's what comes with this sort of level of high-risk, growth-focused investing. And in the wider team that we've built out, the consultants that we have and the venture capitalists, experienced venture capitalists and entrepreneurs that we bring to the table within the fund, we have some great examples of some exits where people have invested, managed those businesses, and ultimately brought that exit to the table, where Target Media, Optimum Releasing being sold to Studio Canal, all sold out for more than 20 times for those original investors. The key point being that actually within the creative industries, quite often people will view the creative industries as a bit of a niche market. You know, where is the value within the creative industries? What does it actually do for UK PLC? And there have been a lot of very, very interesting stats actually banded around over the last 12 months as to just how valuable the creative industries is to our economy. So stats from the DCMS published in 2018, gross value add of the UK creative industries was over 100 billion in 2017. Over the period 2010 to 2017, the growth of our sector, the value add growth of our sector has grown at more than double or around double the UK average. And when it comes to looking at what HMRC are trying to support through the tax-efficient structures, whether it be EIS or VCT, the two elements that we're looking to drive through those structures are growth and employment. Well, the growth figures stand for themselves, but the employment piece is also very, very important. 3.2 million jobs right around the UK, not just London-focused, all around the country, which represents about 1 in 11 UK jobs, which means that the creative industries, you know, rightly or wrongly over the last few years, there have been some rather, you know, questionable headlines about tax-efficient investing and the media sector, but actually fundamentally, when you dig down into what that sector does, it very much is in that growth space and supports employment across the country. And whilst our approach might be seen to be a little bit focused, very much sector-focused, when you scratch the surface of what the UK creative industries is, it's actually relatively diverse. You've got a lot of different subsectors through content creation, through to post-production facilities, through to new media and tech. There is an element of tech within it, within our fund, You can't get away from it. It is everywhere in every business that you look at, through to distribution and the way in which content is delivered to our screens and the way in which we consume it. And that is what our EIS is focusing on and looking to tap into with your clients' money. So what is the investment opportunity? We're looking to invest into a range of media businesses with strong management teams. You can actually strip back the creative industries element of this strategy and just look at what's actually going on underneath the bonnet. And it's no different to a typical early-stage VC strategy. You're looking for great people. You're looking for very strong business plans. You're looking for the opportunity for some serious growth over a decent period. And ultimately, you're looking for a business that is going to be valuable to a bigger business in terms of exit, whether that be through a trade sale or an MBO. Target return of 200%, £2 on every £1 invested. From a fees perspective, 98p of your investment will qualify for tax relief as the initial fee of 2% comes off the top. And we're looking to hold 4 to 6 years, maybe nudging into the 7-year frame. Investments made to date. This is a relatively new fund. This has only been running for around about 15 months. We've had money to spend about the last 12 months. This is a selection of 5 of the companies that we've invested into. We've made 8 investments. By the end of this quarter, we'll have made 8 investments. And one of the companies that I'll pick on, just to bring things together and finish off on, Little Door. Little Door is a production company founded by 2 very, very experienced females in the production sector. Got great CVs, great track record, great pedigree in the content that they've been involved with. Based in Cardiff, they had a great slate of projects in development. They had a commission lined up in the running with Channel 4. We invested in them in August. A month or so down the line, they actually got their Channel 4 commission across the line. And in terms of the value add that we brought to their business after that event, yes, we brought money to the equation, but we also, through our contacts with various different government entities, we managed to help them secure their Welsh Government grant to help with the production finance of that show. And then also, through some of our other funds, have helped put together the finance package to get that show done and made. And that is going into production shortly this year. And so, whilst we clearly bring money to the table, we're also bringing industry expertise to the table. And I think that's important across the piece whenever it comes to early stage investing in the venture capital space in the UK. So, last things to touch on as everyone else to sort of articulate where we are with the sort of the administrative side of things, how we try and make your lives easier. Reporting is 6 monthly. We have quarterly close dates, so we're open throughout the year. Next quarterly close is the end of April, so there's no carryback opportunity here, I'm afraid. This is very much a post-tax year-end close, but will be allotted within 12 months for sure. Current average for full deployment is around 5 months for all the investors that we've had through to date. And EIS3 certificates, the average is around about 84 days post-allotment. So pretty much within that sort of sweet spot of what you'd hope to be able to achieve for your clients. I think that's my time done. I think it's a bit of networking time now. So if you've got any questions, myself and my colleague Jamie Boyd will be upstairs, and hope you've enjoyed the evening.